India's IT major Wipro has announced its fourth quarter earnings. India's fourth largest IT company has beaten street expectations on the profitability front. However, revenues from operations missed estimates. My colleague Suyash Maheshwari joins us to decode the earnings report of Wipro and also to tell us, Suyash, the Wipro stock is down nearly 3% for the day despite beating expectations on profit.
Yes, Krishna, certainly the stock is down 3% and it was a part of the larger market fallout that we saw. The stock ended about 3% lower at the day's end, but the numbers came after the market hours and the numbers look decent actually. Net profit for the quarter is up 4.6% and this is on a year-on-year basis. In Q1, the figure stands at about 3,003 crore versus 2,886 crore in the corresponding quarter of the previous fiscal. Revenue on the other hand fell by about 3.79%, coming in at 21,964 crore versus 22,831 crore in Q1 of FY24. Now the street was expecting the first quarter net profit figure to come in somewhere around 2,953 crore. So the Wipro results have actually beaten or surpassed expectations on the profitability front by about 50 odd crores or so, whereas revenue was expected to fall to 22,229 crore. So there's a decline of about 265 crore from the expectations. But on a sequential basis, I think it makes a lot of sense to look at the numbers of the IT companies on a sequential basis, because we know that these companies have been going through a slump for multiple quarters. So looking at numbers on a quarter-on-quarter basis helps us gauge if the overall outlook for the industry is improving. So on a sequential basis, the revenue has fallen by about 1.14%, whereas net profit has actually risen by 6% almost. That tells us that even though the growth is muted, the companies are moving towards operational efficiencies and the margins are improving for the IT companies. Not to mention, in the commentary of these IT players, we are seeing some green shoot of recovery and discretionary spending is also picking up.